Hey, everybody, this is Russell Gray, co host of the Real Estate Guys radio show, and we're here for a special edition to talk precious metals. Precious metals have really been on the move lately. If you've been paying attention, and if you haven't, you probably want to be, because precious metals are an indicator of what's going on with the dollar. And I think everybody's pretty aware of that big bugaboo called inflation right now. So we've invited a couple of our good friends from the precious metals industry to join us today to share their expertise. First is Brien Lundin, who's the publisher of the Gold Newsletter. He's the promoter of the New Orleans Investment Conference, one of our favorite investment conferences, right up there with our own Investor Summit that we do every year. And Brien looks at things from the macro picture, sees the big picture charts and graphs and kind of what's going on in the mining space, a little bit different from Dana Samuelson, our other guest, who's with American Gold Exchange, who is an everyday in the streets dealer, helping his customers buy and sell physical precious metals in the real world. So I thought that getting a viewpoint from both of these guys from their two different perspectives would be very helpful. So gentlemen, thank you for joining me today.
Great to be with you, Russ, as always.
Yeah, thanks, Russ. Thanks for having us.
No, it's going to be great. So Dana, you and I did that silver series on our YouTube channel, which was really popular. Of course, we did it back in the day when silver was $17, and I think gold was around $1,300 or $1,400 or something like that. And there's been some pretty good moves, a little bit up and down. And you'd have to say that silver and gold have been a little bit flat, relatively speaking, until this recent run up. What are you seeing out there at the street level as far as precious metals go?
Well, demand has surged on the back of the Ukrainian invasion, and we're back into a silver squeeze now, where the dealers around the country are hand to mouth, dependent upon the mints and the refineries to produce 1 ounce silver coins, sovereign minted silver coins, 10 ounce, kilogram, 100-ounce bars. So we're back into delayed delivery situation and higher premiums than normal because the demand has exceeded the what was on the shelf and what these various production facilities can make on a weekly or monthly basis. So delivery times now are 4 and 5 weeks, and premiums are $1 to $2 higher an ounce than they have been. And I think they're going to go a little higher still as long as this situation continues, and there's no sign of it ending anytime soon. Gold, not so much. We've seen a little bit of modest problems with gold, but no real premium increases yet. And as we talked about in the silver series, the gold to silver ratio is between 75 and 80 to 1. So it's 80 times time and effort to make a 1 ounce silver coin as it is a gold coin. And that's really where the rub is. It's in the getting the blanks made properly. So.
Okay, so if you're watching this and all of that just went right over your head, don't worry, just check out our silver series. Dana and I did, I think, 14 or 15 episodes, and we broke down all of the stuff, where the pricing comes from, what the gold silver ratio is, what it means, where the premiums come from. We talked about the supply chain, the differences between bullion and numismatic. So if all of this is Greek to you, we're not going to get into that now, but just go watch that series and then come back and watch this so you can kind of understand the language that Dana is speaking, because he lives in this in a real world. But at the end of the day, we have prices that are relatively up by recent history. And yet when you look at both metals, especially silver, in terms of their historical averages, Brien, silver right now is still at 50% below its all-time high, which it's hit twice in the past. And you got to say, what other commodity in an inflationary environment like that is like that? How do you explain that, or can you?
Well, not that I can explain it. Obviously, there are some games played in the gold and silver markets. There are games played because these are the only true monetary metals, and therefore they're the barometers of government. You know, they show government mismanagement of currencies and economics, et cetera. So there is an incentive for governments to try to keep them corralled and under pressure. I'm not a big believer that gets done on a daily basis. I think that one of the outgrowths of this, or one of the reasons why the markets are manipulated a lot, is because there's a built-in profit motive. The paper, gold, and silver markets, the futures markets, are like Goldilocks markets. They're just big enough where hedge funds with enough capital to put at work can move them around. And they're just big enough that they can make significant profits by doing that. So kind of a combination of those factors means that gold and silver are manipulated a lot on the paper version of those markets, and the price is set there on a daily basis. Long-term prices are set by fundamental supply and demand, and you have a snapback effect when these manipulations get unwound and are forced to be unwound. That's kind of the situation I see we're approaching right now for a number of reasons. So the metals are moving up right now for some great reasons, fundamental reasons, monetary reasons, the kinds of things that add up to multi-year bull markets. The geopolitical issues right now, I think, are an unwelcome distraction to the metals markets. You never want to buy gold or silver based on the headlines on these kinds of things, because there's always a fallback. What's interesting now, or what I think is important to remember right now, is that the metals have moved so much because of this geopolitical issue that it's going to be hard for them to fall back below where they were before these issues began, especially because some of the big monetary factors are just coming to the fore.
Interesting. So let me just take a step back right now, guys, because, we're the real estate guys. And people are like, what in the world are the real estate guys talking about gold and silver for? Well, it's because real estate is really a subset of a bigger category of investments called real assets. And these are things that are physical, that are tangible, that serve an essential human need, that have a long, we're talking centuries, like thousands of year history of being considered valuable by mankind. And so, well, things like crypto, I have nothing against crypto, but it's relatively new and unproven. Fiat currencies have a long history. These are currencies, the paper currencies that governments issue that aren't backed by anything, have a 100% track record of failure. And so even the US dollar, as strong as it is and has been, really has only been detached from gold for maybe just over 51 years. And if you're not familiar with that, Dana and I also covered that August 15th, 1971. Then President Nixon took us off the US gold standard, or took the world off the gold standard, where the US dollar was backed by gold internationally. And so a lot of investors today really don't remember a world where there was real money, or what we call sound money, backed by precious metals. It's always just been fiat. But if you don't know history, and the history of fiat is it eventually fails. And what does that look like? That looks like inflation, where it takes more and more and more dollars, or whatever the currency is, to purchase things that are real. That's why gas goes from $2 a gallon to $5 a gallon to $10 a gallon. That's why houses go from $50,000 for a 3-bedroom, 2-bath to $250 to $500. These real assets don't effectively change in terms of their content, their quality, or the utility, but they go up in dollar terms. And that's classic inflation. And so one of the reasons why I, as a real estate investor, pay attention to gold and silver is they're the gauges that I pay attention to measure the health of the fiat currency, to find out what people are really looking for. And when people get scared in a marketplace, they tend to go into bonds. They especially US bonds. So they'll go in and they'll say, hey, I'm really scared. I'm going to sell my stocks. I'm going to go in, I'm going to buy bonds, because the government can print as much money as they need to. And therefore I'm guaranteed I'm going to get my principal back, right? I'm just concerned with my principal. But when they stop buying the bonds and they start buying gold, it tells you that they no longer trust the bond or the currency it's issued in, the dollar. And so gold can be another indicator of the health of the bond market. And of course, as real estate investors, we care a lot about the bond market. We learned in 2008, when the bond market collapses, it takes the credit markets with it, which means we can't borrow. It means interest rates go up. And we've seen a little bit of that lately. And so, Brien, I'm going to come back to you, and Dana, I want to come back to you and hit the street side in just a moment. But what are you seeing out there, or are you, in terms of a movement from money out of bonds, the relationship between bonds and what's happening in precious metals? Is that something you track? Do you have anything to say about that?
Well, the bond market, interest rates are rising in response to the assumption that the Fed is going to continue to hike rates. Which means that people are worried more about the fundamental value of the currency, more worried about inflation. The big counterbalance to the bond market and the Federal Reserve for years were the bond vigilantes, who whenever they would sense that the underlying currency was not going to be worth as much, would then eschew bonds, and then rates would demand higher yields before they would buy those bonds. That's kind of what's happening right now. And that's done a lot of the work for the Fed, frankly, the anticipation of the Fed raising rates. A couple of interesting things to think about here is, one, that it's a bit counterintuitive but rising interest rates or the Fed going on a rate hiking campaign is actually bullish for gold. It's been that way numerous times, and most famously in December of 2015, when the price of gold soared 30% over the following 8 months after the Fed initially started raising rates in December of 2015. A lot of money was made, not just in gold and silver, but people invested in the leveraged investments like mining stocks. So we are in an environment that's tremendously bullish for precious metals right now. And you wouldn't think that way. A lot of the mainstream investing public doesn't realize this, but it is fundamentally one of the biggest drivers of higher metals prices, because the next big headline to hit the markets is going to be when the Fed inevitably has to stop raising rates, is forced to go back to these easy money policies and go back downward, which eventually it will at some point. The other thing to consider, and it's not it's a scary thing to think about, is right now the bond market is doing a lot of the work of the Fed, raising rates in anticipation and because they're worrying about the currencies. But what happens when the Fed loses control of the bond market? That's the scary thing, because right now they're pulling all the levers, they're telling the markets where they're going to go. But when the bond markets, the bond vigilantes come back to the fore and say, we don't think the Fed can control rates. We don't think the Fed can lower rates in response to the next crisis. We just want to get the hell out of Dodge, and nobody buys bonds, then rates really start to soar. Then, of course, it becomes very difficult for the Fed to finance the deficit spending of the government. That's the kind of thing, that's a scenario that's really scary. And if you say, well, we'd love to have $10,000 gold price, you probably don't. I mean, that's not something you really should wish for. Like H.L. Mencken said, be careful what you wish for. That's a scary scenario. And, people really need to be prepared for that as perhaps an outlying possibility, but a possibility nonetheless.
Well, this is where it goes back to how gold and real estate fit together, because, we can't control whether gold goes to $10,000 an ounce. Basically, that means the currency is failing. What we can control is how much debt we have. So if we go get a bunch of debt against real estate, where the income on the real estate is servicing the debt, we've locked in our cost at whatever it is. And so let's say, for example, it's $100,000 mortgage, and in today's market, roughly $2,000 an ounce. It's going to take me, 50 ounces to be able to pay that mortgage off. And yet in your scenario, if gold were to go to $10,000 ounce, it would only take me 10 ounces of gold to settle that debt. So where you have a chance to beat inflation is not just by owning gold in an environment where everything goes up, but to pair it with debt against something that you want to own, like a piece of real estate. When you retire that debt with the then appreciated gold, you now own the real estate and its income free and clear. And so, this is one of the reasons why, as a real estate investor, really like to have gold in the portfolio when I've paired it with debt, and the best debt in the world you can get is on real estate. So Dana, coming back to you and what you're seeing on the street, because Brien had mentioned in his comments the difference between the paper market and the physical market. And of course, you don't deal in paper. And just for everybody's quick edification or knowledge here, papers are basically just options or futures contracts. So in other words, you say, okay, I'm gonna buy a claim against real physical gold for such and such a price, and later on down the road, I plan to sell that claim for more than I bought it for. And that's the arbitrage, the spread that Brien was talking about. And so that helps impact the price of the metal in both the physical and in the paper markets. And yet physical is very different, because in the paper markets, you can create as much paper as you want. There can be 100 claims for every ounce of gold. There can be 500 claims for every ounce of gold. It's like playing musical chairs, and how many people do you add to the mix versus not adding however many chairs, gold being the chairs and the people being the number of claims, right? How many people would want them? It's only a problem when the music stops. And how do we know when it's stopping? Well, we see that in the physical market. So when you look at the physical market, you mentioned a little bit, but in this context, Dana, what's happening in the physical market? Do you have people turning their gold in now and selling it physically? Are you having difficulties in your supply chain sourcing metals for your customers who want physical? What's happening out there?
Well, most of our activity has turned from into buying activity. Now we have some profit takers who bought gold and silver years ago, well before the great financial crisis of 2008, who like these higher numbers and are taking profits. But the number of people there is small, very small relative to the number of people buying. And we are in an excessive demand situation now, where normally you could buy.
Is that for both gold and silver?
Yeah, both gold and silver. Gold, because it's real portable wealth. I mean, you can hold 100 ounces of gold in your hand. That's $200,000 worth of value right now. That same value in silver would take up a tabletop, and you'd need a couple wheelbarrows to move it. So silver's not as practical in terms of holding, storing, and transporting real wealth. But silver is currency that you can use on the street if you need hard cash, especially 1 ounce silver coins. What we've seen is a premium increase over the last month and a half from $2 an ounce over silver to $4 an ounce on 100 ounce bars. So the price on the street with silver at $26 an ounce at a minimum for most people is $30 an ounce.
So the premiums in silver are telling you that as they're going up, that there's scarcity. Is that what I'm hearing? Yes.
Yeah,
but we're not seeing that yet in gold.
No, because the same amount of gold in dollars is a lot less units to make. So it's not a bottleneck in production for gold ounces yet, but we have seen a little bit of a delay. The Royal Canadian Mint right now is behind on maple leafs in gold, which hardly ever happens. And they're more internationally traded than the US Gold Eagles are, because they're a pure ounce of gold, where a gold eagle is an ounce of gold with a little bit of alloy added to it.
Right. We cover that also in the silver series, the difference between 4 9s and 3 9s.
Yeah, exactly. But to see the Royal Canadian Mint behind in production, which hardly ever happens, especially in gold maple leafs, is an indicator that we could see a squeeze in the gold market too. We're just not there yet.
What about sales? What about just gross volume? Not yours, but just overall. I thought I had read recently that one of the mints had actually stopped production on something. Is that correct?
Well, we've seen the Austrian mint has had some problems, primarily because of COVID, and they got way behind. They had a COVID outbreak a month and a half ago, which shut them down for a couple of weeks, which really helped to trigger part of the silver squeeze, because they're a major manufacturer, and suddenly those ounces are taken off the shelf for 2 or 3 weeks. That's really the only mint that had a real COVID problem over the last Omicron breakout. But when we see premiums rising, that is a shortage. That means dealers are bidding with other dealers to find product, and we're competing with each other first before we can offer that product to our clients. And if I can't get it, I can't sell it. So I have to pay up to get it. And that's what's been happening. So it's not out of hand yet, but it is showing that there's a lot more demand than there is available supply.
Well, I think it's interesting. I totally get the demand side on silver, 50% below its all-time high. Gold, on the other hand, I think the all-time high prior to 2020 or 2021 was 1923, I believe, in 2011. And then it went back down and it kind of floated around for a little while and then worked its way back up, broke over 2000. But it seems to put in a pretty good foundation at over 1900 and seems to be holding that well. I had heard, Brien, that there was some shorts out there, I think, who were expecting gold to fall as a result of the rising interest rate environment. And they got squeezed. And so there was some covering going on that bid it up. It kind of retracted a little bit, but it seems like it put in a good base over 1900. What is you're kind of a chart guy. What are your charts telling you?
Yeah, well, right now, if you look at the resistance, and I know we want to make this fairly timeless, but right now the next levels for gold to hit are 1975, then 1990, but the $2,000 mark is one of those big numbers, and it's going to act like a magnet. So I think we're going to be heading back there. As we speak, we put in a few good days here. I think we're going to be heading back to 2000 in short order, but these big numbers tend to take a few tries to get over and successfully clear. So once you get there, you're not there. It's going to go back and forth and oscillate around that number for a while, and absent some other events. You know, if you look at the situation in Ukraine, that's going to resolve itself at some point. When that happens, we're going to there's going to be a bit of a sell-off in gold. I think the market has kind of discounted the fact that there's going to be a resolution at some point. Right now there's a spectrum. There's a peaceful resolution on one end, there's nuclear war on the other end. So it's become a bit binary. And I think the market has kind of accepted that it will resolve somehow. So a lot of that's built into the price is one thing to consider. I do think we're going to have a bit of a sell-off once there is a resolution, but not as much as we would have if that resolution would have came, say, a couple of weeks ago. There's a lot of momentum behind the market. There's a lot of good things that have happened on the charts that show upside momentum, and I think we're going to continue. And the shorts, you got to feel sorry for them, right? That they get their rear ends handed to them. But they've been betting against gold for a while, and this whole Ukraine thing kind of came out of left field and caused them to cover their shorts. And they're going to keep rebuilding that and trying to get back on the short side of the market, but they can't fight momentum like what we've seen.
And again, just for no investor left behind, the idea here is that in the paper markets, these guys can sell something they don't own, right, which is what shorting is. And so they borrow the metals in this case, and they don't borrow the physical metals. They just write a contract and then they sell it in the market, hoping they're going to be able to fill it later by buying it back cheaper. And they make their money on that profit. It's basically placing a bet on downward price action. When you get caught on the wrong end of that, you have to fill at whatever price is available. And then you end up bidding to fill, and that bids the price up. So we saw a little bit of that dip in the shorting and then a rise. But then when I think most of that has settled now, but again, putting in a base above 1900. And Dana had mentioned that, Brien, that he's seen fairly robust physical demand at the retail level. Do you pay any attention to what's going on at the institutional or the central bank level? Is there buying happening there?
Yeah, there is. And that's where the price gets set, frankly. On the retail level with the boots on the ground, where Dana is, a lot of that's manufacturing issues. Who would have thunk it that government-run mints aren't good business people? Amazingly, they don't really respond to supply and demand. They don't like to carry a lot of inventory. They're always caught by the swings of the market one way or the other. So a lot of that reflects the fact that, as Dana mentioned, that it takes these are manufactured products. There's lead times involved. You have to source the metal, create blanks, manufacture it, et cetera, et cetera. So the retail demand tends to overwhelm that. It always does. It happens over and over again. Where the price
but Brien, let me just interject. Is that more reflected in the spot price or in the premiums?
Premiums first, availability second. I think Dana would agree with that. You can get the entire available supply wiped out over a weekend. I mean, we've seen that happen how many times over the last 10, 15 years, Dana? Whenever there's some big issue erupts, all of a sudden you have to pry whatever product you can get. You have to pry it out of really strong hands. So that means high premiums are necessary to do that. So that's on the retail end. But when you get to the industrial end, as it were, the institutional end, you're talking 1,000-ounce bars of silver, and that's where you get the silver ETFs, the physical funds out there. And it's important to tell people that it's great to use those facilities, those products, if you want to play the market. But they're
meaning
not
trading, buy low, sell
trading.
high, and hope you end up with dollars.
Yeah. If you want to try and take advantage of the macro picture, but if you buy something like SLV, which is the big silver ETF, and GLD, the custodian for those ETFs is JP Morgan, which is, the U.S. Justice Department has called that a criminal enterprise, and we should probably believe them. So they're the custodians. They are most likely, or it's very possible that when they supply physical metal to the vaults, they're probably hedging that or shorting it in the market right away or selling it back into the market. So there's no net effect on the physical supplies of those bars. PSLV, which is the ETF run, actually it's a trust run by Sprott, is one where they're actually buying the metal and putting it aside. They also have one for gold, and the symbol for that is, I believe,
PHYS, Phys.
Yeah, PHYS, short for physical. And I recommend that people use those ETFs if they're trying to buy in bulk. I still have a big silver position in PSLV right now that I bought within days of the pandemic starting. So I'm just holding on to that, and I've added a bit to it over the intervening months. I look at that as really just a cash holding. It's just a holding of money, like I would money in the bank.
And Brian, I think you bring up a good point that I want to make sure everybody recognizes is if you understand that the banking system is very fragile and the bond market is very fragile and rising interest rates are problematic, especially for people that have a lot of bonds. Sometimes the banks can benefit from rising interest rates because it enhances their profits a little bit. But if you're nervous, if you've got assets above 250,000 and you don't want to park those things in treasuries, precious metals is not a bad place to park it. You can pivot into any currency because there's always a bid in any currency on gold. And there's no counterparty risk. Once you hold that physical gold or silver in your safe at home or wherever you keep it, as long as you are in possession of it, nobody else has to perform in order for you to have value. Unlike an IOU, like a bond, the bondholder has to pay. And the list goes on and on. So there are definitely strategic reasons as an investor why you would want to have some physical precious metals in your portfolio. And then again, to my earlier comment, if you pair that with some debt against some good cash flowing real estate, you're in a position to really benefit from a collapsing currency. And you can watch what's happening as far as the currency goes just by watching headline inflation. I mean, when it shows up on the CPI, which we all know has been doctored down from the original formula they used back in the 80s, real world inflation, at least according to Shadow Stats, is probably closer to 15%. Yeah. That's pretty substantial. And, you're not getting anything near that in most of your investments. So one way to hedge against that falling currency is in the precious metals. So I'm going to come back to you, Brian, because I have a couple more macro things I want to talk about. But Dana, when you're talking to your customers, especially your seasoned veterans, the people who have been buying metals for a long, long time, they're what we call strong hands or holding on to it for the long haul. When you're getting in conversation, do you have any anecdotal wisdom that you've picked up from talking to these people?
Well, we have a wide variety of people that we do business with. Most of our clients are small business owners. They're independently wealthy. They don't trust the system and they don't trust the dollar, which is why they like precious metals. They like having their money outside of the system and having some of it, at least, safe haven without counterparty risk. And most of them, to a person, are not happy with the way the inflation is going. I was talking to one of my clients the other day, and we were discussing inflation in the 70s, which we both lived through. Most people haven't today, and inflation today. And the biggest difference between then and now is in the 1970s, the US was a creditor nation. Today, we are the biggest debtor nation in the world. And when Volcker raised interest rates to 14 and 15%, we had credit on our books. Now we have debt that we have to service, which is why the Fed will be hamstrung in trying to raise interest rates. And I've watched Powell's last two press conferences before this last meeting, and he really tipped his hand that he is a dove. That man is a dove, and he does not want to raise interest rates hard and fast. But the inflationary market's going to force him to. Another thing I want to just put out there is that this Ukrainian conflict with Russia is deeply inflationary because it's affecting some of the most basic things of life that we need. Oil's way up, as you all know.
Fertilizer, food. Yep.
Fertilizer is a big thing that most people don't get. Ukraine and Russia both produce fertilizer and wheat. So there's going to be food problems coming. And I saw a video yesterday of Ukrainian tractors pulling Russian tanks. Some of the farmers in Ukraine are stealing the tanks when they can, and they can't plant their crops, which is the problem, which is what I'm getting at. So this whole inflationary cycle that we're going through is going to get turbocharged a bit until this conflict is resolved, as Brian was talking about earlier, one way or the other.
Yeah.
So the arbitrage between interest rates and inflation allows your precious equity strategy to work perfectly, Russ.
Yeah, and again, just for those of you that don't know what that is, basically it's a concept that you look at equity that you have in real estate, which could go away as soon as interest rates rise or credit markets collapse. So you grab it while you can, you lock in cheap interest rates, putting more debt into your portfolio, and you think, oh my gosh, debt comes with a payment. Yes, it does. But you can make investments on the other side. So pure arbitrage is where you borrow or you invest in, you buy and sell the same asset at the same time. In this case, you're going to take out a loan and harvest equity from a property. And then you're going to make a loan where you're going to get a spread on that. So if I can borrow money out at 4% and I borrow, say, a couple $100,000, and I can take $100,000 and invest it in a first position note against a piece of real estate, I've taken out a loan and I've made a loan, but with only half the proceeds, I've covered 100% of my cost. So now I have the other 100,000 free and clear, and I can go purchase precious metals, and I have no real basis in it. I mean, I have $100,000, that's true, but it's borrowed money. And so then now if the gold ends up doubling in value, let's say, and I think Bank of America has had a call out there for $2,500 or $3,000 gold for quite a while. It's probably up now since we're getting a lot closer. But at whatever point, then you can go back and retire that debt for a fraction of the gold, and then you end up with free gold. And so, we can get more into depth on that. That's just a very simple strategy about how these things go together.
It's powerful. It really is powerful.
Yeah. So for everybody, I think that, let's see, I'm trying to think of how I did a presentation on that. We'll come back to that. I'll try to figure that out. So, the other thing I want to talk about, I got two things I want to talk about that are on macro. And so I'm going to flip back to you, Brien. And one is oil. Oil is obviously in the news. Everybody feels it at the gas pump every day. And oil is a big cost of mining, and it is a component of cost in getting precious metals out of the ground. And so, like with everything, energy is the economy, and everything that has to be produced or shipped has an energy component in it. In mining, energy is a big component, and that puts in another form of putting a base in. When you talk to your mining company executives and they're looking at their cost to get the stuff out of the ground and get it to market, how is the cost of oil impacting that? And are they thinking this oil thing is going to be a permanent long-term situation they have to deal with, or are they viewing it as kind of an anomaly based on these geopolitical tensions?
Yeah, I don't think anybody has a view that it's probably semi-permanent. I think that the view is going to take a couple of years. There's a lot that goes into it. In the U.S., outside of the political impediments to growing production, which are going to be here at least for the remainder of the Biden administration, there are other issues. In fracking, that was what created on the margin, the increase in production. Fracking sand, the price is essentially tripled and supplies have been curtailed. So that's limiting the frackers from going out and trying to fill in that gap. You bring up a great point that not a lot of people know about is that rising oil prices, rising diesel prices really collapses the margins of the big miners. It takes a lot of diesel to run those big yellow trucks. And not many people saw that. If anybody saw that before, say 2010, 2011, when that really hit the market. And never before, I believe in history, had we seen a position where the gold price was rising. I mean, from the 2008 lows to the 2011 peak, the gold price essentially tripled. But the miners, for the first time in history, didn't catch up or didn't leverage that move, keep up with the move, because their operating costs just increased tremendously. The price of oil rose to over $140 a barrel during that period. So they really weren't making that much money, even though the price of their product, their output had essentially tripled. We may see that again, and I think we're seeing that happen right now. Even though the price of gold and the price of silver are going up, to big open pit mines that have a lot of those big yellow trucks operating, they're not making as much money, and their margins are collapsing in that process.
Well, isn't that the way it always goes, is that when you have inflation in any component of cost, the company absorbs it in their profits initially until at some point the production is curtailed, and then scarcity creates increase in supply, or the market allows them to raise the price because it has to. And at some point, it ends up being reflected in the price of the final product. I think that what I'm hearing you guys say is that that we have issues in the supply chain at the street level. We have demand issues in the physical market at the street level and at the institutional level. We have the cost of energy going into setting more of a base or lifting the base price of getting the metals out of the ground, a component of cost. And you have this issue in the bond market. If interest rates go up, then bond values collapse. For you real estate investors out there, it's the same with market cap rate. So if you look at an apartment building, if the income doesn't change, if the income stays the same and the cap rate goes down, that means the price went up. If the cap rate goes up, it means the price went down. So bonds are cap rates going up, meaning the bond prices are going down. And if you're a bond holder, you want to get out before that steals your equity. And so, this is for the people who get confused. They're like, I don't understand how could there be 16 or 18 trillion dollars of negative yielding bonds in the marketplace? Why would anybody buy a negative yielding bond? And the reason they do it is because they think rates are going to go even further negative, and they're speculating on the price. Well, the reverse is true. If interest rates go up, bond prices collapse. And so now people who are trying to be conservative have to get out of bonds, and they have to find an alternative. And that, I think, is also bullish for the price of gold. So I think there's a lot of things that I'm hearing, particularly for precious metals, and not the least of which, the other thing we want to talk about, Brian, is the geopolitical. And let's talk about that, because you had mentioned before we went on mic that you wanted to talk about this, and this is the way the sanctions are being applied to Russia, and they've already been locked out of the dollar market. And the response was, okay, well then we're going to demand that our oil, and they're one of the largest oil producers in the world, you got to pay us in rubles. So you're stepping away from the petrodollar. So that's one thing against the dollar. Of course, they a long time ago divested themselves of their treasuries. But what about gold? They have Russia's been a big buyer of gold and built a big position. And like Venezuelan before them, trying to convert that into dollars or whatever currency they need, but they're being sanctioned. How do you see that impacting the gold supply and demand balance?
Yeah, it's a big issue. I had as we mentioned, I had a national media organization contact me shortly this morning before we went on the air and asked my opinion on the idea being floated now that the Western world is going to sanction Russian gold reserves. And, in my email,
which are stored where? Some of which are stored
in Russia, of course. So Russia's central banker is a woman, Nabulina, I think her name is. I think that's the pronunciation of her name. But she's absolutely brilliant, smartest central banker out there. Not only has she been selling U.S. treasuries and converting the proceeds into gold, not only has she been taking the Western companies mining gold in Russia and forcing them to accept rubles for the gold, so they're selling the gold to the central bank. So she's been printing up new rubles, getting gold and putting it in their national reserves and storing the gold there. So it's a real conceit of, and really arrogance that the West thinks that they can sanction Russia's central bank gold reserves. It shows they just really don't understand gold. Right. Russia could sell that gold in smaller quantities anywhere in the world. It's completely untraceable. There's no counterparty, as we've said.
I'm sure China would buy it.
They could sell practically the whole thing to China in a heartbeat, because China has been, of course, China would demand a nice discount from their standpoint, but China's been buying gold hand over fist for years and would love to take Russia's gold. And that's something nobody would know about except the parties involved. And if they spoke about it, they wouldn't last very long on this earth. So anyway, the gold could be sold. It's untraceable. But the knock-on effect of this is what's really interesting, because if they would say that Russia can't sell its gold, that would be essentially an announcement to the 36 countries that have significant portions of their national gold reserves held in the Federal Reserve Bank in New York City. It would be essentially telling them that you need to get your gold back in your country as soon as possible. And as was shown when Germany tried to get its gold back, just a small portion of its gold back in 2014 actually. Yeah, 2013. The Federal Reserve said, okay, we'll send it to you, but it's going to take 7 years. And that was an announcement to the world that the gold ain't there. I mean, you could.
And when they got it back, the gold bars that they had deposited, with the serial numbers and all that, they got newly minted bars that had been, melted down from whatever source. They didn't get back their original gold. And so the backstory on this, Brien, is interesting for those that don't know. After World War II, Europe was a mess. And so to keep their metals safe, which was wealth back then, gold was the standard around the world. Many of these countries shipped all or some of their gold to New York for safekeeping, to the United States for safekeeping. And, so the United States was acting as a trustee, as a custodian of this gold. And of course, the thing about physical gold is it gets hypothecated, which means borrowed against or lent out, and it can get rehypothecated. And so you can end up having lots of people thinking they have physical gold on deposit somewhere, but they don't. And that's a whole different thing. But these large holders of gold, when they have reason to believe that the gold may not be there, it literally is a run on the bank, just like in It's a Wonderful Life, right? You distrust the custodian. You're not sure your money's going to be there. And the only way you know that you actually are going to have your wealth is to repossess it, get it back in your own hands. I think Venezuela with Hugo Chavez way back in the day kind of kicked off a big flurry of that with his 150 tons, and he had a big parade. Of course, he ended up having one of those heart attacks shortly thereafter. I'm not sure if those two events were related. And then later on, sanctions against Venezuela caused them to cough up their gold. It ended up in London, and then they tried to get it back and they couldn't get it back. So that was a whole thing. I pay a lot of attention to gold. And I remember when that Germany thing happened, and the same thing, I thought, wow, that is a clue. And I think other countries, Netherlands, there were several other countries right after that happened that all started asking for their gold back. And then I think there's been a little bit of a lull in that. But what I hear you saying, Brien, is if the people who have physical gold on deposit at the Fed realize that the Western central banks or the Western world may decide to sanction that gold and they have physical possession of it, they have some real power. Get it out while you still can. And what happens when they do that if that gold isn't really there?
Well, that means that the U.S. government is going to have to go out and find that gold in the open market. And that's a lot of gold.
Physical. They can't buy paper. They got to fill it with physical.
Right. Exactly. Right. Physical gold that has long since been sold into the market by institutions who leased it from the central banks at very low interest rates, then sold it into the market, probably put those funds immediately into U.S. Treasuries, which are ironclad collateral to use to leverage up their other investments. So in other words, you're right. Instead of gold being held, there are paper IOUs for JP Morgan, et cetera, et cetera. And everybody's going to have to go find that gold, lickety split. And it's not out there. So they're going to have to pay whatever price is necessary. And, that could create, that could be a real catalyst to much higher gold prices and completely upset the market in very quick order.
So another thing I'd say is bullish. So to put it in real estate terms, because our audience are primarily real estate investors, if you've ever looked up Walt Disney acquiring the land to build Disney World in Florida, he didn't want anybody to know he was doing that, because if people figured out that he was aggregating all of this land, that what it was worth to him, then that one person who's got that one little parcel, that little piece that he needs to finish his puzzle, could really hold out for a high price. And so I think that we as individual investors can recognize there's a ton of pressure right now on big players to pile into gold. And if in fact you start seeing gold being repatriated from the West to, from the New York Fed and the custodians of it here in the Western central bank system to sovereign nations, then they're going to have to go source that gold, which according to Brien isn't there, from the street. And that means they're going to have to make a bid on it. They're going to have to bid it high enough to shake it out of strong hands. And if you're smart, you're going to wait till that bid goes way up. It's kind of like when you get bumped on an airplane and they're like, hey, we'll give you $200 for your seat. Nobody bites. We'll give you $300 for your seat. Nah, nobody bites. I did that one time with a family of 5 and I ended up getting $700 per seat or a family of 7. So we ended up with $4,200 or something like that, $600 per seat. So if you wait long enough, you can get bid up. So I think that what I'm hearing is the case for gold and silver pretty bullish right now, based on energy, based on supply and demand, based on geopolitical unrest, based on rising interest rates and the flight to safety out of bonds into something that is less interest rate sensitive, like precious metals. Dana, any closing thoughts from you? And then Brien, I'll give you the last word.
No, I think this is one of the more interesting periods of time we're going to go through, and there's going to be a lot of challenges, and how you protect yourself and your family in this environment. You have to be defensive, and what worked 2 or 3 years ago is not going to work in this environment. So you have to look at things differently. And I really think that the arbitrage between the inflation rate and the interest rates right now is so extreme. Like I said, your precious equity strategy works brilliantly for real estate investors in particular. And there's the two of the best things to hold in an inflationary environment are real estate and precious metals. So they're
and debt. Don't forget the debt.
Right.
Got to have the debt.
But liquidity could be a problem, which is why having some precious metals is important, because they're always liquid if there's a problem with the banking system. Or
much better to have the equity on your balance sheet in precious metals than in real estate equity, right? You want debt on the real estate. You want the equity outside of the real estate where it's safer and more liquid.
Right, especially if we see the dollar continue to devalue in its purchasing power, which is inevitable. So that's my closing thought.
Well, they're going to have to print tons of dollars in order to save the bond market, because if they raise interest rates, they're going to implode the bond market. They're going to have to step in just like they did in 2008, and they're going to print. I mean, the Fed's balance sheet, who knows? Could the Fed's balance sheet went from 800 billion or 800 billion to what, 9 trillion right now, whatever it is, pushing 10 trillion. It's a big number. Yeah, could it go to 20? I don't know. We'll see how long the dollar can survive. But if you don't have a strategy for hedging against a collapsing dollar. So Dana, you and I are going to be doing a Q&A, and Brien may include you on that as well. So if folks are like watching this and are interested in just understanding precious metals, and this is all kind of Greek to them, which I totally get. We did as I mentioned earlier, a series, the Silver Series. So if anyone watching wants to check that out, it's just send an email to silverseries@realestateguysradio.com. And if you have questions for Dana, we're going to do a Q&A, just like this, a recorded Q&A, and we'll answer your questions. Just send your question to AskDana, D-A-N-A, AskDana@realestateguysradio.com. And we'll gather up those questions, and we'll schedule a recording session. We'll get those questions answered for folks. And so, Brien, coming over to you, as we've talked about all this, I know you've got the New Orleans Investment Conference coming up. We attend every year, as I mentioned at the top of the show. It's one of our favorite investment conference. In fact, it is our favorite investment conference, besides our own annual Investor Summit, which is totally sold out for this year. Super excited about that. And we have a couple of new faculty members that are surprises we're going to be announcing shortly. But don't get too hot and bothered because you can't sign up. We're sold out. Get on the waiting list, and then hope that you can get in early for the 2023 edition. But tell us a little bit about the New Orleans Investment Conference and the big plans you have for that this year in 2022.
Yeah, we have some great speakers at the conference, obviously headlined by you and Robert. But we've so enjoyed your participation over the last now like 7 years. I think you guys have been such a big part of our show, of our event. But it really is a gathering of some of the brightest minds around in the markets today, and analyzing these markets. We're coming up on 50 years of this event. It's the oldest investment event, oldest investment conference in the world today, and it's always important to attend because you get a lot of different views from a lot of really smart people. But it's even more important to attend when things are really uncertain, when there's tumult in the markets, when the world's realizing that the paper game is in danger. And that's precisely where we are right now. I tell people, if you want to boil everything down, it's that what we see right now, none of this is normal. No matter what the Federal Reserve says, no matter what they say on CNBC, no matter how much they act like everything's under control, it is in danger of really spiraling out of control. What we have right now are inflation rates that are not only where they were in the 1970s, they're exceeding what we had in the 1970s if you measure them as we did back then. The difference being right now is we didn't have the kind of debt that we had back in the 70s as we have today. And we had Paul Volcker, and there ain't no Paul Volckers around today.
Well, nobody could raise interest rates. The system is flawed fundamentally. It's the end of its useful life. When we hit the zero bound in interest rates, that was the beginning of the end. And I think there's been a great drive towards having or taking advantage of various crises over the last couple of years in an attempt to reset the system. It's not conspiracy theory anymore that the people who run things want to do a great reset, whether it's a central bank digital currency, one world currency, SDRs replacing the US dollar as the world's reserve currency. I mean, these things are no longer tinfoil hat out of the mainstream conspiracy theories. These are things that Main Street investors need to start paying attention to, because we're at the end game. And that's what the New Orleans Investment Conference is all about, is getting together smart people who pay attention to these things, study the macroeconomics, the fundamentals, understand the mining and the metal sector, have context, history. This thing is ancient, right? You've been doing this for 46, 47 years, something like that.
Yeah. Yeah, in Gold Newsletter, we trace our beginning back to that August 15th, 1971 date. So it's a 50, even 60-year trend that is now, as you say, reaching its end game. We don't know how much longer it's going to go, but the phase is accelerating. The trends are accelerating as we speak. So the bottom line being, you need to be prepared for this. You can't sit on your hands with what's coming down the pike. It's not too late to get prepared. You need to really figure out what's going on. You need to listen to some of the people that we're bringing to New Orleans, and act on that. Get positioned, prepare yourself.
Yep. I think
whether you're prepared or not.
Yeah, better to be prepared and not have a crisis, and have a crisis and not be prepared. Right. Back in 2013, I did a presentation at the New Orleans Investment Conference about real asset investing, wrote a report called the Real Asset Investing Report. Turned out to be prescient when you go back and look at it. If you want to get a copy of that, it's free. Just send an email to realasset@realestateguysradio.com, and you can get that report, and consider that it was written in September 2013, and everything that's transpired in the last, 8.5 years now. So if you're interested in attending the New Orleans Investment Conference, including the Real Estate Guys infamous party, we always have a party every year. We are the party throwers. Just send an email to neworleans@realestateguysradio.com, and we'll get you all the details about the New Orleans Investment Conference. Gentlemen, we could go on and on. There's so much to talk about. Every time I get together with you guys, I get so excited, because there's so many things I want to learn and talk about. But Dana, we'll do the follow-up on the Q&A, and Brian may invite you back to join that. We're going to have you both on the radio show here real soon. So those of you watching, be sure to watch for that. And meanwhile, send your questions to Ask Dana, any questions you have about all things precious metals, and we'll get those things answered. Guys, thank you so much for being with me today. Really appreciate it. Keep up the good work, and we'll be talking real soon.